Now, personally, my opinion for that specific company, based on our analysis, it's 33 points out of 52 for quality. It means that it's high range. It's not ideal company, but it's pretty strong company. Now, where it's lost points, first of all, ranking. So timeliness rank only out of 5, 2.5, so half of it. Industry rank out of 4, it's got only 2. No, it's 5 out of 8 in timeliness, 5 out of 8 in safety, 2 out of 8 out of 4 in industry ranking. Okay, and that's, you see, I put quite low points. Okay, it's only 2, so they lost 6 points here. Beta is pretty good. Growth trend also, they lost a bit, although probably I can put here 12 as well. And they may, because I understand why they had this growth rate in earnings a bit lower than in sales, because they had this acquisition. So, but generally growth rate trend is quite good in this particular case. And management is also pretty strong, good. And the only reason why I put 6, not 8, because they have a drop in their earnings since last year. Okay, so that's why they lost some points here. So, and that's how I got to 33. Now, if you look at price analysis, so how much, and the way we do it for the guys who are just new, the way we do it, we look at P ratio for the last 5 years, average P ratio. And what happens, what we do, we add the highest prices, because every year a company goes up and then goes down, goes up and then goes down. And what we do, we calculate the highest prices, divide them by amount of years, in our case 5, and we get average high. And then we do exactly the same with low prices. And we add them together and we get average low. So in average, we know that during the last 5 years, the company was moving from $21 to $32. That's average range. And then we calculate and see how much money company was making, like earnings per share during these 5 years. And again, average was 1.9. And that one we do, okay, fine. So we know that in average, this is low price, and that's how much company was making. So what we do, just a second. So what we do in this particular case, we divide them price by earnings, and we get this P ratio. Okay, and we know that when the price drop down, it means that something is bad with this company. Like, I mean, emotionally bad with this company. The earnings exactly the same during that year, but people perceive something bad about this company. So we understand that when something is not right, media news or something else happens in this company, people pay only 11 times. So 11 times of their earnings. So if they earn $1, they would pay $11.1. Now, in our case, the average is 1.9. So it means that in average, during the last year, they're paying like $22. Then we take the maximum. So when everything is good, everything is fantastic, people love this company, good news coming up about this company, everything is around good as well, and people pay 16 times of their earnings. So what we do, why we need these two parameters? First parameter, we say, okay, fine, this is the worst case scenario. That's how much we're paying. Let's think, what's the worst earnings can happen? And the worst earnings, usually it's last year, but in our case, it's this year, okay? Because last year, the company was making $2.8. Now they're making only $2. So that's what I did. I took 11, P ratio 11, and multiply it by 2. And the price, which I come up, $22. So that's where, in average minimum, the company price has to be if the earnings are going to be staying in the $2 level. Okay, so this is 22. The highest range, I say, okay, fine. How much company is planning to make in the future? And they're planning to make $4.8. Okay, that's their projections within the next 3 to 5 years. And I say, okay, if the company is growing and making all this money and people love this, so they're going to pay 16 times as previously in average. I multiply them and I get $79. So it's a bit less conservative, like less optimistic than compared to value line. Remember, value line put from 60 to 100. In my case, it's from, let's say, 60 to 79 to $80. Okay. What I do, when I see the lowest price 22 and 79, I have three ranges. So I believe that within that period of time, 30% of the time is going to be close to the highest price and 30% to the lowest price, and somewhere 30 times, 1/3 of the time, somewhere in the middle. Okay, and that's how I break it to the even parts. And that's how we identify the buying range, holding range, and selling range. So in our case, from 22 to 41, that would be a buying range. That's where we consider to enter the position. The company is going to be undervalued, considerably undervalued on that range. Between 41 and 60, it's normally valued, and over 60, it's already kind of on the overvalued part. That's where we consider to sell that company already. Okay, so this is kind of the idea. Current price is $20. So it means that it's already 10% below the lowest estimate. So that's what gives us an idea that this specific business right now is overvalued or undervalued. So that's why I took it for tonight's masterclass, and I'm going to show it to you. I'm showing it to you. Now, another thing which I wanted to cover, it's a balance sheet, like not the whole balance sheet, but book value. Book value, what is the book value? Book value, it's equity value. So if you take all assets within a company, everything what they have, and sell it, and then convert it to cash, and then give to the bank whatever you own to the bank, how much is left? And whatever is left, you divide by amount of shares. That's what you get book value called. And book value here is $19, but then there is a tangible book value. Tangible book value, you take away all intangible things. Okay, and some companies, they have a lot of intangible assets, they call. And if you go for intangible book value here, tangible book value, so it's only minus 29, so it's negative. So it means that if you try to sell tangible things, which like table, computers, cars, whatever they have tangible, which you can touch, and then you sell it, you even won't have money to pay the debt. So if the company goes into bankruptcy and the intangible assets cannot be sold, so shareholders will receive zero, nothing. Okay, so now when we look at some businesses, like for example, car manufacturers or other type of manufacturing facilities, tangible book value would be the most important. But in this particular business, we can consider that intangible value, like intangible assets, they also very important, because the company business model is, for example, some guy, some crew, filming crew, going to Alaska and they're filming polar bear or like white bears and whatever penguins there, and they create this content. And after that, what they do, they give the right, they sell the rights to show this content to Discovery Channel. And Discovery Channel owns intangible asset. Okay, it's not a tangible, it's intangible. They own the right, because the movie itself, it will worth nothing as soon as they put it on the internet and reduce the rights. Okay, so they own intangible and they can resell it. So that's why I believe that we have to pay attention to this book value, total book value. The only thing, as I said, I didn't manage to have a look at the amount of goodwill, because we definitely, from this book value, we have to deduct goodwill, because goodwill is no good, right, for us. But still, see, book value is very close to the current price. And a lot of people, a lot of investors, traders, they don't go into financial details very deeply. Okay, and the way they look at this, they go and see, oh, book value is 19, the current price is 20, so it means I'm quite secure, because if the share price drops and goes into liquidation, I get $19 back. A lot of people think like that. They don't even understand the difference between tangible book value and intangible book value. Okay, this is quite a huge thing. Okay, pay attention to that. And then earnings. Earnings are going to be in 15 days, 5th of November. So again, if you don't want to be stressed about the future earnings, because majority of moves happen during the earnings, even though we're going to look now in technical analysis, the company doesn't make huge moves during the earnings, up or down, so they're kind of stable in this particular sense. You still might wait until the earnings are over, and then if you decide to invest in this company, then you can allocate the money. Or if you invest before now, so make sure that you exit before that. All right. Okay, guys. And probably the last thing which I wanted to show you from fundamental part is the institutional level of ownership. Usually the companies which we cover, they have from 70 up ownership. So because the companies which we find, they kind of loved by institutional investors. And here only 30%. The question, guys, for you, why do you think the company is pretty, like, I mean, interesting, right? Why institutions, they don't buy it? Do you have any ideas? Give me ideas. I'll tell you my opinion on that, but I want to hear your opinion. Okay, can you put some opinion? You can turn on the microphone if you want and tell the microphone, or if you want, you can chat. Okay. The question was here, where do I get 3x4? Guys, I just let you know that we have different members here, and some of the members, they go through, we called it value investing course, where we analyze all fundamental data. We look at balance sheet, we look at profit and loss statement, we look at cash flow statement, we look at other parameters, and also we have a special spreadsheet where we put information and it gives us certain like numbers, right? I showed you the end part of this spreadsheet where it already shows the results, and that's where we come 4x4. It means 4 quality and 4 price. It means the best companies to invest. That's how we analyze perfectly good quality companies and undervalued companies. Okay, that program will start in the early of next year, maybe January or February. So if somebody wanna join it, so guys, you're very welcome to do that. Okay. Now, okay, I don't see any suggestions why it happened, so I express my own opinion. Now, if you manage somebody's money, some people's money, if you're a hedge fund manager, you have to have a checklist, because when you attract clients' money, you have to give them a prospectus how you allocate the capital. And you have to set on a checklist. And for example, in this checklist is going to be, for example, parameter like debt. Majority of the debt is very important. So I presume that a lot of businesses, they have to put a debt level. And can you imagine what kind of normal level of debt people are looking for? Not more than 50%. So if the company has 50% debt of their capitalization, they have a checklist. We don't invest money into the companies with that level of debt. Even if they like the company, even if they understand that it's undervalued, even if they understand that this debt is, the company can pay this debt quite easily because their earnings is quite high, they still cannot invest in this business just because it doesn't go through their checklist. Because if they break their rules, they can be liable. The client can sue them for breaking the rules, because they tell you, you promised me you're going to do safe investment, and now you're investing in companies with high level of debt. So that's why institutions, they kind of avoid businesses like that. Maybe even they want to buy it, but they can't buy because of their policies and procedures. That's reason one. Second one, reason is dividends. A lot of institutions, because they put big money, big amount of cash there, they don't trade on the daily activities. So they don't care how much company moves within day. What they also paying attention is to dividend level. And the previous companies, which we looked in previous master classes, they all were 3, 4, 5, 6 sometimes % in dividends annually. That's what big corporations, they focus on, dividends. And this particular company doesn't pay any dividends. So as a result, it's not loved by institutions. That's why it's only 30% of their ownership. Okay, guys, do you understand it? Put pluses that you understand,
yeah.
if you agree with me. Okay, in this particular case. Yeah, somebody wants to say something? All right, so the next thing which I wanted also to pay attention is a short float. That's information from FinViz. So we can see that the total amount of shares floating right now is $480 million, or 480 million shares. And look, short float 9.7%. It means that around 10% of all amount of shares sold in short. For those people who don't know how it works, basically the person believes that the share price is going to drop. They don't have shares, so they cannot sell them. The way they do, they borrow shares from the broker. They come to the broker and tell, we want to borrow shares. And the broker says, okay, take my shares. So broker doesn't take any money. They pay certain commission to him, but they take the shares. And after that, they sell shares to the open market. For instance, right now, the person borrowed the shares today and sold it for $20.10. Why? Because he believes or she believes that the share price drops to $19, and then that person will buy at $19 and sell and give it back to the broker. So basically what happens is like normal investing in reverse. So instead of buying shares and then selling, the person sells shares first, which he doesn't have, and then to buy them back, okay, and makes money on the drop. Now, what's the risk here? The risk is here that the person sells the shares. Now he doesn't have the shares and still own the shares to somebody else, and then the share price starts going up. So can you imagine if the person borrowed shares and then sold them at $20, and now the share price already $22, and the broker can at any time ask them, okay, give me shares back. So that person would have to buy shares at $22 and give them back. So lose $2. And if share price goes to $30, that person will have to buy at $30 and give the shares back. But he sold them at $20, so lost $10. So the shorting is very dangerous kind of strategy if people don't understand how to work with that. And another thing, can you imagine that right now the company is dropping their price and a lot of people believe that it keeps going down? So what happens if the share price starts moving up? What do you think their action, what these people do? If you're already in trading area, so most likely they're going to put a stop loss. They're going to close this position. They're not going to sit and wait until the share price goes to $30. They are going to use technical analysis, and they're saying, okay, fine, my stop loss is at around $2 or $3 level, like higher. So not 2 to 3% higher. So as soon as the share price goes higher than 2 to 3%, I'm going to buy those shares and give it to the broker back. So I fix my loss. And here, look at this parameter, short ratio. What means short ratio? Short ratio, if we take the last 30 days and see the volume of trading within these 30 days, and we understand that at the moment, the amount of shorters, if they decide to cover the short position, so they need to buy, they have to buy for nearly 12 days with the same volume. If the volume remains the same as last 30 days, they're going to spend like nearly 12 days to cover their short position. Now, usually it doesn't happen this way. So nobody is going to sell them shares. Usually when they start to buy now all together, what happens with the price, guys, you think? It's going to move quite a lot, because what they do, all these guys, they put in order to buy and nobody is selling there, okay? And because everyone wants to cover their loss, the share price might jump. It's called short squeeze. When the share price moves very, very fast, it can move 10, 20, 30% above that particular level, okay, until all the shorters are covered, okay? This is a good thing for me when I see undervalued company, because I understand if the move happens, even short move, when it triggers their stop losses, after that the price just jumps up. Similar situation, we looked, the last company which we analyzed with similar type of ratio was BGS, and I think it was January or somewhere earlier this year. And after that, that's what happened. Earnings report, they showed better earnings than expected, and the price moved up nearly 30%.